The ASX 200 closed at 8,516 today, down just 0.1%, barely a scratch. Oil at $108 dominated headlines again, Iran again. But while the market's attention stayed fixed on crude, something quieter was happening in healthcare. The S&P ASX 200 Healthcare Index has fallen 33% over the past 12 months. 8 of the 10 largest healthcare stocks are trading at or near multi-year lows. CSL, Australia's biggest biotech, once a market darling, touched an 8-year low of $133 last week. Today it closed at $141, down another 2.2%. This is not a sector in a temporary dip. It is a sector that has been systematically dismantled. And yet, the upgrades keep coming. This week, UBS reiterated a buy on CSL with a 12-month target of $235, a 66% premium to current price. Ord Minnett upgraded Sigma Healthcare to buy. Jefferies upgraded it too. Morgan's is at accumulate. The pattern across the sector is consistent. Brokers cutting price targets, then upgrading ratings. That combination usually means one thing: the sell-off has overshot the fundamentals. The case is structural. CSL's core plasma business is intact. Its Behring division remains the largest plasma-derived therapies business in the world. The CEO departure and cost restructuring created noise, but UBS's $235 target implies the market has priced in a permanent impairment that hasn't materialized. ResMed is a similar story. Shares down 10% year-to-date, trading near 20-month lows. The GLP-1 scare, the fear that obesity drugs would kill CPAP demand, turned out to be wrong. ResMed's own data showed GLP-1 drugs increased sleep apnea diagnoses by 10%. The fear repriced the stock. Reality never followed.
Sigma Healthcare, down 12% over the year, is trading well below the levels justified by its Chemist Warehouse merger synergies. Morgan's moved to accumulate only because the stock had already recovered and then gave that back. Retail investors are noticing. Since the Iran war began, stake trading data shows Australians piling into beaten-down tech and healthcare names alongside energy ETFs. They bought CSL, WiseTech, Zero, Zip on the way down. The most traded ETF by volume wasn't the oil fund, it was broad market exposure. The buy-the-dip instinct is not irrational here. The sector has compressed by a third. Currency headwinds from a stronger Australian dollar are real, but mechanical. Labor cost pressures are cyclical. The underlying demand, aging populations, chronic disease management, sleep health, hasn't changed. The break condition is specific. CSL's revenue growth needs to turn positive. The company restructured costs, margins improved, but as Ord Minnett noted, top-line growth is hard to come by. If the next earnings result shows another quarter of flat or declining revenue, the 8-year low may not hold as a floor. For ResMed, the benchmark is the next quarterly CPAP shipment data. If GLP-1 adoption accelerates faster than expected, particularly Eli Lilly's tirzepatide uptake in Australia, the demand tailwind narrative inverts. That's the one number worth watching. The ASX healthcare sector is sitting on a paradox. Institutional analysts are upgrading into a multi-year collapse, citing valuations that imply permanent damage that hasn't happened yet. The dip buyers may be early. They may also be right. CSL's next revenue print is the tell.